Good afternoon. It's Peter Klein, Chief Investment Officer, co-founder, Align Wealth, with you this afternoon. It's the 29th day of January 2025, market closed. Okay, so we are in the first month of the new year, new administration, lots of things happening, lots to unpack. Let me share the screen and get right to it. So you could see where we are in a moment when I advance the slide. There we go. Here's our take. Here's what we think we're at right now in this environment, in this market. First off, we've been speaking about this for some time, the sticky inflation scenario. Inflation is not easy to vanquish. It's insidious. Once it gets itself into the markets, it's hard to get rid of it. You usually need a recession or a wealth impact, market event. That kind of thing could change inflation, but otherwise, it's sticky. And historically, we've seen second wave of inflation coming after the first wave, after a couple of years of mitigation. So I think that that's probably not in the market, and yet it's something that we concern ourselves with. There are three secular reasons why we are, inflation hawks, if you will, or sticky inflationists. The first is the deglobalization efforts, the tariffs. These things are very inflationary. Number two, decarbonization efforts around the world, inflationary. We got to do it, I get it, but it's inflationary. And the third D is debt and deficit spending, also inflationary. So you have this mixture, this setup that suggests to us that rates are not going to come down so quickly because of this sticky inflation, and there's a playbook that comes with, as you'll see in a moment. On the market side of things, we are certainly seeing some positive changes afoot in Europe. So that works to our favor because we see Europe and Japan as opportunistic, as you'll see in a moment with some slides that depict it. Valuations back here in the good old USA are at, we'll call them dizzying heights. No matter what you choose, price to sales, price to book, price to earnings, price to forward earnings, CAPE, et cetera, you're going to find at the high, you're at the high end of historical norms. That gives us some pause. As we know, it is not a short-term timing tool. It is a long-term perception tool. And perception would suggest that over the course of the next few years, we're less likely to see robust returns given the valuations that we currently have. That's notwithstanding a potential re-rating of the market or a contraction of the market prices, which then allow for potentially better valuations and therefore an opportunity to position at lower prices. Sentiment right now is very frothy, very bullish, the AI craze. And, we're pushing back against that a little bit, as you'll see in the next slide. So our playbook, very simple, cash over bonds. Again, we think rates are going to be stickier, higher for longer. So obviously we prefer being in the riskless asset. I also suggest value over growth, international over the US, a small and mid over large caps, and real over paper, real assets being infrastructure, being precious metals, to some extent real estate, to some extent commodities. We're suggesting we fade the Mag 7 rally, this AI-infused jump that we've seen in the last 6 to 12 months. Perhaps it's time to give it a breather, especially when there's some news, and the news came out this week about potential other operators or other chip manufacturers. Not sure how that plays out, simply to say that it's probably gone a bit too far in the short term. I think over the long term, it's going to change it the way we do everything. I get it. But over the short term, I think a lot of it's been pulled forward. So let's be a little circumspect there. Themes, again, of course, water and infrastructure, free cash flow yields. These dividend growers are cheap, and they're great companies. These are dividend aristocrats where you've seen increasing dividends each year for 25 years, a very hallowed group of special situation companies. Cybersecurity is an ongoing theme. We see it as a way to play AI, the second derivative plays. I mentioned them before, copper and power production and data center build-outs with HVAC. And of course, we're interested in bio and pharmaceutical, healthcare, very cheap, and gold and real assets. So let's get into it. You'll see here how concentrated the market is. Folks, this is a serious flashing yellow light of caution. When you see this type of concentration, you get concerned. This is 40% of the top 10 stocks, the most we've seen since the 70s. And look what happened after that previous top, right down. So, you see that, you say, okay, we're probably now, that doesn't mean that all stocks do poorly. That simply might mean that it broadens out, right? The other 493 broaden out. That's very possible. And that's why you always want to have a balanced approach. Investors are all in. That is also a concern. If that speaks to sentiment, that is a concern. You'd rather buy when obviously people are running away from equities, not running towards them. The prices are bidded up. Who's the next marginal buyers going to be if everybody's already in? Plus, when there's everybody investing, a little bit of a move can make a big change in the markets. So we've got to be careful there. Here's the often mentioned valuation question. Here's a composite from our friends at Hussman, and you can see here, no matter all the different indices put into a composite, the value-based indices, the valuation-based ones, all-time high, all-time high. Best to buy when prices or multiples of value are at lows, not highs. Of course, I know that's hard to do because at the time you're worried and scared and not buying. It's easier to follow the herd. That's not often the right move, though. This is a theme that we're talking about, is the electrification theme, the HVAC build out. These are second derivative AI plays. Here you'll see how quickly the AI has jumped and how much electricity it will require. And the news from earlier this week, notwithstanding this, it's still very, it still seems to us that electric, not only AI and data centers, but also EVs and others, more electrification is happening, as you can see here, the grid investment. And maybe, and you know what, we need to increase that, fix that grid and repair it and bring it back to the 21st century. Here's that dividend slide I mentioned. Dividend growers haven't been doing very much. Look at the last 2 decades, awfully weak. So I would see as these dividend achievers, these dividend growers, as an opportunity. This is the non-US portion of the talk. As you can see in the first slide, European stocks are traded at a deep discount. Deep discount. That's in blue versus the US in red. Look at that wide disparity. Now, you could say that disparity has been going on for a while, and it has, mostly right after the great financial crisis, but it has certainly widened over the course of the last 2 years, as you can see here. And I believe that is an opportunity to value-minded investors seeking good, solid, blue-chipish companies with dividends and growth at discounted prices. And you're not going to get them in the good old USA, or if you do, it's hard to find. You'll see them a lot more in international markets. The second slide is interesting. It looks at the European market versus the S&P, the US market, without NVIDIA. As you can see, it's actually, the MSCI European market actually outperformed. So that's interesting how NVIDIA is sort of everything in the S&P, which is, it gives you something to pause about. Okay, healthcare. The first slide, the one on the right, really speaks first, right? It shows you how much spending as a percentage of the GDP is in the healthcare business, healthcare industry, huge and growing. Yet the stocks on the left side graph have done nothing in the last 2 years. I think that's an opportunity, not just for biopharmaceuticals and pharmaceutical companies, but even for the biotechs in some cases. They look really interesting and washed out and opportunistic. Remember, many of the big pharmaceutical companies are coming off of a patent cliff and they need to regenerate their pipeline of patents. How do they do that? They buy companies and they buy usually smaller biotech companies to fill in that pipeline. So expect some additional M&A from there. Okay, winding it down here, second opinion service, folks. Portfolios are moving, markets are moving, things are changing. It's always a good idea in January to get a gut check on how the portfolio is positioned. And, looking at your portfolio or having a professional look at your, not unlike an annual checkup at the doctor's office, look at the portfolio, give you a sense of how you're doing versus your risk tolerance and your objectives, give you a sense of what the themes are in your portfolio, if there are any, and just see where you're positioned. And it's never a bad idea. It's no obligation. We're happy to serve. So feel free to reach out to us at alinewealth.com, and we'll be certain to help you go through these measures. So listen, thanks very much for your attention. Very much appreciated. Look forward to chatting again. If there is something on your mind, if there's a question about how you're seeing things in your portfolio or the markets, feel free to email us at alinewealth.com, and we will be happy to answer those questions and make some time to talk about it. Thank you very much for your attention. Thank you for your continued vote of confidence. Talk with you soon.